All right, everyone, let's talk about the big elephant in the room that I've been hearing a bunch lately, and it's, are we in a real estate bubble? I'm so sick of hearing this. I really am, because I've been hearing we're in a real estate bubble since like 2013. And the reason why is I bought my first house in 2013. And I can remember reading an article from, I think it was like CNBC or something like that. And it was talking about how the next bubble is going to be at the end of 2013, potentially 2014. And then basically every year after, you've heard like, oh, the market's about to pop, the market's about to pop. The most I heard it though was like 2008. I'm sorry, 2000, of course, 2008. But the most I've heard about it was in 2018 and 2019. Now, when a lot of these people are talking about it, they're talking about the economy. In this video, I'm not talking about stocks. I'm not talking about cryptocurrency. I'm not talking about the economy. I'm talking about just the housing market. And as weird as it might sound, the housing market has a tendency to be separate from the economy. And in fact, if you look in the past 6 recessions that we've had in America, only one of them affected the housing market. And that was 2008. And we don't have to go into detail about 2008. I'm sure everybody knows what it was. Now, the interesting thing is, when I'm listening to all these other folks talk about why we're in a bubble, nobody's talking about the housing market. They're talking about all these other factors, even though what I see is a lot of these factors don't affect the housing market. So let's look at pre-2008. So when I say pre-2008, I'm just saying, let's say like about 2004 or 5 to 2008, right? So if I say 2008, I mean kind of that window of time right there. Let's look at what buyers were actually doing back then that put them into position to cause 2008, right? Because I truly believe that 2008 was caused by corporate greed, consumer ignorance, and consumer bad habits, right? And I'm actually starting to see that in some ways now, but that's for another video. So pre-2008, there were 2 loan products that you saw a lot of folks do. And one of them was called an ARM, which was an adjustable rate mortgage. So essentially what that is you get a mortgage and it had a really, really low interest rate. And then after so ever many years, it jumped up to a really high interest rate. And that people didn't necessarily expect that. And then you also had taxes that increased. And then these people got smacked with the large monthly payment that they couldn't make. So they had to sell, foreclose, or short sale. The other ones that I saw, and the most predominant one, was 80/20s. Now, 80/20s, back then, people would get an 80/20 loan and they'd roll all their closing costs into the loan. So essentially what that is, if you're not familiar with what an 80/20 is you'd get an 80% loan and you'd get a 20% loan, then you roll your closing costs in. So to kind of give you an example of that, let's say you bought a home in 2007 and it was $250,000, right? Well, you got the 80/20, so it's 100% financing. So you don't have any money into the home. Then your closing costs like escrow, which is like your taxes and stuff, your insurance, anything like that, closing costs, let's say it's $10,000 on a $250,000 home. So now you have a loan for $260,000. Let's fast forward a little bit, and let's say we're at the end of 2008, early 2009, and that individual is hitting hard times, right? They lost their job, whatever it might be, and they need to sell their home. So they call the bank up and they talk to the bank and they said, hey, I owe this much on the home. I bought the home for this much. I'd like to sell it. What do I need to do to get out of this? The bank says, oh, okay, well, you could do a short sale. Well, let's say in this particular scenario, the seller hasn't been delinquent on any payments. The bank says, hey, you need to be delinquent in order to be to be able to do a short sale. So the seller misses a handful of payments. Now they're delinquent on the mortgage, so they can apply for a short sale. Well, sometimes this trapped people, and I don't think the banks did it on purpose. It was just miscommunication, and the folks would get foreclosed on anyways. This is real stuff that happened back then. Or the other one was they tried to do a short sale. Because in order to sell your home, this same person, they bought the home for $250,000, they rolled in $10,000 of closing costs, and now to sell the home, it's about $17,000 in closing costs. So now you have to sell the home for about $280,000 just to break even, right? Does that make sense? That's how the short sales happened. It was the worst sales ever. I hated doing them. I knew I was trying to help people, and the banks paid all the closing costs and did all that. but it was horrible because I mean, you definitely didn't have the happy closing day pictures with these folks. I guarantee you that much. So let's look at two factors that were causing this. All right. So number one was how the appraisals were done. So back then, let's say I'm a lender and somebody comes to me and they're getting a purchase or they're purchasing a home for $250,000 and I've got two appraisers. I've got John, I've got Susie. So I call up John. I'm like, hey, John, I got a home on 123 Deer Run. Its contract price is $250. You think you can make that happen? John says, oh man, I don't know. That's pretty tight. I don't think I'm going to be able to make that happen. So I say, hey, John, I appreciate your time, buddy. I'll talk to you later. Then I call up Susie. I say, hey, Susie, I got this home over on 123 Deer Run. Can you make it happen for $250? Susie says, oh yeah, Chris, no worries. I'll be out there. I'll get you that appraisal by the end of the week. Okay. I say, hey, great. Appreciate you, Susie. You have a great day. That's how it happened back then. The appraisers weren't really authentic. I'm not bashing appraisers, but that's kind of what you saw back then. Now, the other aspect about that was the supply and demand. The supply of homes back pre-2008 in North Texas was sitting at about they were sitting at about 3 to 4 months supply of inventory. So let's say you bought that home for $250,000. You have a loan for $260,000. To sell your home, it's going to cost $17,000. So you got to put that on top. And then we're at about 3 to 4 months supply, which is close to a neutral market. So the home doesn't appreciate at all. Now, fast forward, like I said, to the end of 2008, 2009, there's no equity in the home. You got to get a short sale or a foreclosure. Now let's look at present time. All right, let's talk about the loans that I'm seeing now. Right, so you're seeing a lot of cash buyers. Let's not talk about the investors. That's for another video. I'm talking about people that are actually buying homes. You're seeing folks move here from other states that are buying the homes with cash. You're seeing people that are downsizing that are buying homes with cash. You're seeing people that are getting loans where they're putting down 20%. So they get the true 80-20. And by the way, you can no longer finance your down payment. I guarantee you if you do that, that underwriter is going to catch it. So you can't finance your down payment anymore. You can get a gift from like a family member, but they have to write a letter saying that it's not a loan. And with buyers that I've been working with for about the past 2 years, most of them are putting 10% down or more, and the vast majority of them are putting down 20% or more. And on some of my listings, I've been getting offers where people are putting down like 40, 50, 60%. So let's look at that scenario. Let's take that same home pre-2008 that was worth $250,000. Let's say now it's worth $500,000, right? And you have a buyer that comes in and they submit an offer. They buy the home. Contract price is $500,000. They put 20% down. Now they have a loan for $400,000. Let's say that appraisal came in a little bit low. In the vast majority of cases, the buyer is having to make the difference up, right? Contract price, sale of the home was $500,000. Just for the sake of this, to keep it simple, they put down 20%. They owe $400,000 on it. The buyer has to pay all their closing costs. They can't roll that into the mortgage anymore, right? So that's what I'm seeing in regards to the mortgage. Now let's move over to the two other factors that we talked about pre-2008. The appraisal process is completely different. They figured out it was a bad idea for the lenders to reach out directly to the appraisers. So now let's just say I'm the lender. I have to metaphorically drop the address in a bowl. And in that bowl, there might be a dozen appraisers. And then one of those appraisers picks the address up, goes out, appraises the home. And I feel like you do get a more authentic appraisal like that. Now, it really falls on the listing agent to supply the information to the appraiser if the folks have done like some upgrades or maybe there's been some private sales and things of that nature. And unfortunately, you don't see that very often. But you do get a more authentic appraisal. Now, the other aspect of that is the inventory. So I would say for about the past year and a half, North Texas has been sitting at approximately about a month's supply. And right now it's definitely below a month's supply of inventory. So when you figure that people that have bought a home in the past 2 years or so, and if you bought pre-2000, I would say about pre-2019, I mean, you definitely have a ton of equity in your home. Inventory is super low. We have got some wiggle room for the inventory to go up, and we're still going to be in a seller's market. So when I see these professionals talking about that we're in a housing bubble and they base it on everything else except for the housing market, honestly, I don't know where they're coming up with this stuff. And I hope I'm right. I really, really do. But there are a few things that I want to keep an eye on that are making me a little bit nervous. Interest rates are one. I'm a little bit nervous about what the interest rates are going to do. And then this is very specific to Texas, is going to be the taxes, right? I hope that the state of Texas comes together and says, "Hey, our property taxes are pretty damn high, and we need to make some changes to it." But outside of that, I don't see anything causing a housing market bubble, burst, crash, whatever you want to call it, at least in 2022. I just don't see it, and I don't understand why I'm seeing so many experts that are looking at all these other factors. Right now, people have more equity in their home than they've had, I think, since I've been alive. The vast majority of owners have more equity in their home. And if things do go a little sideways and people hit hard times and they have to sell, I think the demand is going to be there, and it's going to keep us from having a real estate crash. I'm not talking about the economy, by the way. Inflation, all that stuff, that's kind of crazy. What I'm talking about is the real estate market. I don't see values in homes just plummeting like they did pre-2008 or in 2008. I'm sorry. So anyways, folks, that's the end of the video. I hope it was helpful. Hope it was informative and maybe gave folks a different point of view than what I'm hearing out in the masses of why the next housing bubble is going to happen.